Your boss just learned that firing you makes the stock go up. Not in some abstract, theoretical, well, lower costs are technically good for shareholders kind of way. In a very real, very public, very recent kind of way. Block, the company that owns Cash App and Square, fired nearly half of its employees in February. 4,000 people, gone. And the stock didn't dip, it didn't wobble, it didn't even pause to think about it. It jumped 24% in after-hours trading. 24% in one night for firing 4,000 people. Now PayPal is doing the same thing. Coinbase is doing the same thing. Salesforce, Meta, Citi, Cloudflare, Pinterest, CrowdStrike, Chegg, all doing the same thing. The phrase you keep seeing pasted into every press release is AI-driven restructuring, which sounds like the title of a McKinsey report nobody asked for. But strip away the language and what you're actually looking at is the most successful corporate strategy of the decade. Fire your people, mention AI in the press release, watch the stock climb. It's that simple, it's that ugly, and it is, by every measurable signal Wall Street is currently sending, completely working. So today, we're going to talk about what's really happening here. Because this isn't a tech story. It's not even an AI story, not really. It's a story about how the stock market decided, somewhere between 2023 and now, that workers are no longer a sign of a healthy company. They're a sign of a bloated one. And once a CEO sees that on a balance sheet, on an earnings call, on their own stock chart, they don't forget it. Here's the question. Once Wall Street has openly cheered for mass layoffs at one company after another, what exactly do you think every other CEO in the country is going to do? You already know the answer. You're just hoping it's not you. Let's set the scene properly, because the numbers in 2026 are genuinely insane. In the first 4 months of this year, tech companies alone laid off around 128,000 people. That works out to roughly 1,000 workers a day. Every day, weekends included. And these aren't warehouse jobs or seasonal retail roles. These are six-figure software engineering jobs, mid-level managers, customer service teams, marketing departments. The kind of jobs that used to be considered recession-proof. The kind your parents told you to aim for. Add in the non-tech layoffs and you've got over 1,600 companies announcing mass job cuts since January. UPS is letting go of 30,000 people. Citi is in the middle of a 20,000 person reduction. PayPal just announced 4,760. BioNTech almost 1,900. Nissan 900 in Europe alone. And here's the part that should be making you twitch a little. The stock market is at a record high. The S&P 500 just touched 7,400 for the first time in history. Corporate profits are setting records. The companies doing the firing are not, by any normal measure of corporate health, in trouble. So what's going on? Well, that's where it gets interesting. Because the official story, the one in the press releases, the earnings calls, the CNBC chyrons, is that AI is making workers redundant. The technology has gotten so good, so fast, that companies simply don't need as many humans anymore. Painful, but inevitable. The cost of progress. Tragic in the short term, prosperous in the long term, and so on. That story is partly true. AI tools are genuinely getting better. They're genuinely automating things. But it is not the whole story. It's barely half the story. And the half it leaves out is the half that explains why your boss is suddenly so excited about ChatGPT. It's time to pull back the curtain on the AI layoff stock boost. Let me walk you through how this actually works, because the mechanics are simpler than most financial commentators are willing to admit. Imagine you're the CEO of a publicly traded company. We'll call you Dave. Dave has a problem. Dave's company makes a reasonable profit, but the growth has slowed. The stock has been flat for 2 years. The board is getting twitchy. Activist investors are circling. Dave needs to do something. In the old days, say 10 years ago, Dave had two real options. He could grow revenue, which is hard, slow, and depends on customers actually buying more stuff, or he could cut costs through ordinary restructuring, which would be unpopular and would make Dave look like a vulture. The market would punish him for it. Layoffs used to be a sign of weakness. They were what struggling companies did right before they got bought by a larger one. Wall Street viewed them with a kind of suspicious sympathy, like watching someone sell their grandmother's wedding ring at a pawn shop. But then, somewhere around 2023, a strange thing happened. Tech companies that had overhired during the pandemic started firing people, and instead of being punished, they were rewarded. Meta laid off 21,000 people across multiple rounds, and the stock went vertical. Salesforce, Google, Amazon, all of them did massive layoffs and watched their share prices climb. The lesson Wall Street drew from this was very clear and very dangerous. Companies don't need all these employees. The ones they have are dead weight. Get rid of them and the market will reward you for it. Now, fast forward to 2026. Dave is reading the financial news. Dave sees that Block, a company that wasn't even in financial distress, laid off nearly half its workforce and gained 24% in a single trading session. Dave does the math. 4,000 jobs cut, maybe $400 million in annual salary savings, maybe more. And in exchange, the company's market value increases by several billion dollars overnight. Several billion dollars. Think about that for a second. Block created more shareholder value by firing 4,000 people in one day than it has by launching new products, signing new merchants, or expanding into new markets in the past several quarters combined. The math is so absurdly lopsided that no rational CEO could possibly ignore it. And here's the thing, they're not ignoring it. Now, you might think this is just the natural consequence of AI making jobs obsolete. The technology improved, the workers became unnecessary, the market correctly priced in the new reality. Painful, but rational. I want to gently suggest that this view is, at best, half right. And the wrong half is the half doing most of the heavy lifting in the explanation. Here's why. If you actually look at the companies doing these massive AI-related layoffs, the cuts are almost never targeted at the specific roles AI is replacing. They're company-wide. PayPal isn't just cutting the engineers whose work has been automated. They're cutting 20% of the entire 23,800-person workforce. Block didn't just fire its support staff because chatbots got better. They cut customer service, marketing, sales, ops, recruiting, internal tooling, all of it. About half the company. This is not what surgical replacement of human labor by machines looks like. This is what cost-cutting looks like when you found a magic word that makes investors clap instead of frown. And that magic word is AI. A few years ago, if a company announced it was firing 20% of its workforce, the headline would have been, "Company in trouble, stock down 8%, analysts asking concerned questions on the earnings call, maybe a downgrade or two." Today, the same announcement with, "as part of our AI transformation" tacked on the end, gets you a different headline entirely. Company embraces the future. Stock up 15%. Analysts asking excited questions about margin expansion, maybe an upgrade. Same layoffs, same people losing their jobs, same company, totally different market reaction. The only thing that changed was the framing. Now, are some of these layoffs genuinely connected to AI productivity gains? Sure, probably. AI coding tools have legitimately made engineers more productive. AI customer service tools have legitimately reduced the need for some support staff. The technology is real and the savings are real. But here's the crazy part. The market doesn't actually care whether the AI story is true. It cares that the AI story sounds true. As long as the press release contains the right words, AI native, agentic workflows, becoming a technology company again, flatter and more efficient, the stock goes up. Whether the company has actually deployed any meaningful AI or just put a chatbot on its homepage is, for the purposes of the stock price, totally irrelevant. This is why the Block CEO's note to employees was such a tell. Jack Dorsey wrote, and I'm paraphrasing, that the company was already seeing that AI tools combined with smaller, flatter teams enabled a new way of working. He said he'd rather get there on his own terms than be forced to do it reactively. And then he said something that should have made every CEO in America sit up very straight. He said, "Within the next year, I believe the majority of companies will reach the same conclusion and make similar structural changes." Translation, I just figured out the cheat code and the rest of you are about to use it too. And here is where we get to the actually scary part. Because this isn't just one company or one industry or one weird moment. This is a contagion, and it's spreading. PayPal's new CEO, Enrique Lores, took over in March of this year. By May, he was on his first earnings call announcing 20% workforce cuts, $1.5 billion in savings, an AI transformation team, and the company becoming a technology company again. He'd been in the role for 2 months. 2 months. He didn't have time to actually understand PayPal's operations, let alone identify which specific roles could be automated. But he had time to copy the playbook. Coinbase did the same thing the same week. 14% of the workforce, around 700 people, AI native operating model, exactly the same vocabulary. Cloudflare, 20%. The list keeps going. Now, you might think this is a coincidence, a bunch of companies independently arriving at the same conclusion. Sure. What's actually happening is that boards and executives are watching each other in real time. They see Block's stock jump 24%. They see PayPal stock react. They see how the language is being received by analysts, and they're sitting in their own boardrooms thinking, okay, when's our turn? There's a useful concept from finance called the agency problem. It's the idea that the people running a company, the executives, don't always have the same interests as the people who own the company, the shareholders. In theory, the board exists to align those interests. In practice, the way they do that is by tying executive pay to the stock price. Most CEOs of large public companies make the bulk of their compensation through stock-based bonuses, stock options, restricted stock units, performance shares. If the stock goes up, they get rich. If the stock goes down, they don't. So when a CEO sees that one single decision, fire a bunch of people, mention AI, can move the stock by double digits in a single session, that is not an idle data point to them. That is, quite literally, the most lucrative discovery of their entire career. It can be worth more to them personally than a decade of strategic execution. This is the part nobody on CNBC wants to say out loud. The reason AI layoffs are spreading isn't because AI got that much better in the last 6 months. AI got better, yes, but not 8 jobs overnight better. The reason they're spreading is because they pay. They pay the executives doing them. They pay the shareholders holding the stock. And the only people who don't get paid are the people whose desks are now empty. You already know who that is. You don't need me to tell you. Now, before we go further, I want to be fair, because there's a counter-argument here that's worth taking seriously. The bull case goes something like this. Throughout economic history, technology has destroyed jobs and created new ones. Tractors put farmhands out of work, but they also fed the world. ATMs put bank tellers out of work, but they also expanded financial services. Email destroyed the fax-related economy, and somehow we're all fine. Progress is messy, it's painful, but over the long run, it makes everyone better off, including the workers who get displaced. Because the economy ends up bigger and more productive than it was before. If AI is actually making workers more productive, then firing some of them isn't immoral. A company that needed 10,000 people last year and only needs 6,000 this year shouldn't keep paying 10,000. That's just hoarding labor for sentimental reasons, which is bad for the company, bad for the shareholders, and arguably bad for the economy, because that labor is being kept from more productive uses. This is a real argument. It's been the standard economic defense of every wave of automation for the last 200 years. And it has, broadly, been correct over those 200 years. But here's the thing. There are 2 problems with applying it to this particular moment. The first problem is timing. Historically, the productivity gains from new technology have shown up in the economic data before the layoffs. Companies adopt the new tools, become more productive, grow into their newfound capacity, and only then realize they don't need as many people for the same output. That whole cycle usually takes years, sometimes decades. What's happening now is the layoffs are coming first. The productivity gains are theoretical. Companies are firing 20% of their workforce on the promise of AI tools that, in many cases, they haven't even fully deployed yet. They're cutting first and figuring out the AI part later. That's not how productivity-driven workforce reduction normally works. That's how cost-cutting normally works with a clever cover story attached. The second problem is who benefits. The historical defense of automation rests on the assumption that the gains eventually trickle down, that the bigger, more productive economy creates more jobs, higher wages, and a rising standard of living for the average worker. But for that to happen, the gains have to actually circulate. They have to be invested in new businesses, new wages, new training. Right now, the gains are getting handed straight back to shareholders. Block didn't fire 4,000 people and use the savings to retrain them or invest in new product lines or expand into new markets. They return the value to shareholders in the form of a higher stock price. Same with PayPal, which is targeting $1.5 billion in run rate savings and has been pretty explicit that the savings are the point. This is the part of the story where the analogy to past automation cycles breaks down. The tractor didn't just make farmers richer, it also created a giant new industry of tractor manufacturing, tractor maintenance, agricultural science, food processing, and everything downstream. Whole towns got built around that. The AI cycle, so far, is not creating tractor factories, it's creating bigger margins. And bigger margins in 2026 are going to two groups of people. The shareholders, who are overwhelmingly the wealthiest 10% of Americans, and the executives, who are overwhelmingly the wealthiest fraction of a percent. The displaced workers are not getting jobs in new AI-adjacent industries. There are no AI-adjacent industries hiring at scale yet. They're getting unemployment, severance, and if they're lucky, 6 months to figure out a new career. So yes, technology destroys jobs and creates new ones, but the new ones don't usually arrive on the same day the old ones leave. And in the gap between those two things, somebody has to actually live, pay rent, buy groceries, make a mortgage payment. That somebody, right now, is roughly 1,002 tech workers a day. Here's where this gets genuinely worrying for everyone, including, eventually, the people doing the firing. A company exists in a broader economy. It sells things to customers. Those customers, for most companies, are other people who have jobs. When you fire your workers, you're saving on your payroll, but you're also, in aggregate, shrinking the pool of customers who can afford to buy what you sell. For one company doing it, this doesn't matter at all. PayPal's 4,760 ex-employees are a rounding error in the global payments market. They'll still need to buy stuff. PayPal will be fine. But what happens when every company starts doing it at the same time? What happens when the entire S&P 500 simultaneously decides that workers are now dead weight? That AI is a magic words machine that makes stocks go up, and that the smart play is to cut headcount by 15 to 20% and hand the savings to shareholders. You get a feedback loop. Fewer workers means fewer customers. Fewer customers means weaker revenue. Weaker revenue means more pressure to cut costs, which means more layoffs, which means fewer customers, and so on. There's a name for this kind of dynamic. Economists call it the paradox of thrift. It's the idea that what's rational for one actor, saving more, cutting costs, becomes irrational, even self-destructive, when everyone tries to do it at once. It's how recessions deepen. We are watching, in real time, a corporate version of the paradox of thrift play out across the American economy. And the stock market, which is by its nature a short-term incentive-aligning machine, is cheering it on. Now, you might think the stock market would eventually catch on. That at some point, the analysts would do the math and realize that an economy of fewer employed workers is an economy of fewer paying customers, which is bad for everyone's stock, including theirs. I'd love to tell you that's how this works. It's not. The stock market is, famously, a voting machine in the short term and a weighing machine in the long term. And right now, the votes are very, very loud. Let me bring this down from the abstract and make it real for a second, because I think the macro story can sometimes paper over what this actually means for individual people. Imagine you're a mid-career marketing manager at a mid-sized tech company. You've been there 4 years, you're good at your job, your performance reviews are solid, your manager likes you. You bought a house last year, you've got a kid in elementary school. One Tuesday morning, you get a calendar invite for an unscheduled all-hands at 9 a.m. You know what it is before you click it. Everyone at every tech company in 2026 knows what an unscheduled all-hands at 9 a.m. is. The CEO comes on the video call, says something about a strategic restructuring and embracing our AI-native future, and within an hour, you're locked out of Slack. Severance details to follow. Meanwhile, somewhere in a different time zone, an analyst at a big asset manager is updating their model. Workforce reduction, yes. AI mentioned, yes. Margin expansion, estimated. Stock target, raised. Your former CEO's stock-based compensation just appreciated by several $million. Yours just went to zero. You'll be fine, probably. You have savings. You'll find another job eventually, although probably not as quickly or at as high a salary as you'd have liked. Because every other company is doing the same thing. The job market for marketing managers is bad and getting worse. You'll cut back on spending for a while. You'll skip a vacation. You'll feel a slow, grinding anxiety that doesn't quite go away. This is happening to 1,000 people a day, just in tech. Across the broader economy, the number is much larger, and every one of those people is somebody's customer, somebody's renter, somebody's borrower, somebody's depositor. The cost of these decisions doesn't disappear because Wall Street isn't pricing it in. It just gets distributed across the rest of the economy in ways that take a year or two to show up in any chart anyone is looking at. So what do you do? I'm not going to pretend I have a clean answer for you, because I don't. Nobody does. But there are a few things worth thinking about as this trend keeps rolling. First, understand what your job actually looks like to the people above you. If you're at a public company, your salary is a line item on a spreadsheet that gets shown to investors every quarter. Your boss may genuinely like you, but remember, the CFO and CEO is incentivized by every structural force in the modern American corporation to make that line item smaller. AI just gave them a new tool and a new story to make that happen. Second, the jobs that are safest right now are not, contrary to popular belief, the most AI-resistant ones in some abstract technical sense. They're the ones whose elimination would not produce a satisfying narrative on an earnings call. Nobody pumps a stock by announcing they fired the plumbers. AI as a stock-pumping tool requires that the eliminated jobs be plausibly automatable in the minds of investors, which means knowledge work, white-collar work, software-adjacent work. The exact kind of work that, until very recently, was considered the safe and aspirational career path in this country. Third, and this is the financial advice part of this video, if you have any kind of job in the categories above, your number one priority right now should be increasing the runway between you and a missed paycheck. Build the emergency fund, pay down the credit card. If you've been thinking about that side income, this is the year. The traditional advice about job security through skill development is still true, but it is not enough on its own anymore. Because in 2026, the question is not whether you're good at your job, it's whether your job survives the next earnings call. And finally, pay attention to who's actually benefiting. Because the AI productivity revolution, the way it's currently being structured, is not a story about technology making everyone richer. It's a story about technology making a very small group of people much, much richer, while making a much larger group of people significantly poorer in the name of a story that hasn't fully been written yet. That's a political problem more than an economic one. And whether or not anyone in Washington decides to do something about it will shape what the next decade of this country looks like for everyone watching this right now.